Welcome everybody to this month's property market update. We are looking at CoreLogic's monthly housing chart pack, and we're going to be have a look at a few news reports as well as CBAs annual reports to see what's happening with the banks. Now let's start with CoreLogic's most recent data. You can see here that the national home values rose by 2.9% over the past 3 months. The highest quarterly movement since January 2022. However, the monthly growth has slowed to 0.7% from 1.1 in June. So the market's still growing, it's still performing quite well, but that rate of growth is starting to slow down. You can see that the majority of the growth is happening in Perth, Adelaide, Brisbane, and in Sydney. Sydney is leading the pack at 4.5%, and some regional markets are performing quite well. Now we'll just keep on scrolling through here. I really do enjoy looking at the quarterly change in the different mix of what parts of the market are growing the most. The lowest 25% of values, the middle 50%, and then the top 25%. It gives you an indication of who's buying property and what parts of the market are performing the best. In Sydney, you can see that the top part of the market is performing the best, and it's been really leading the charge, growing at 5.2%. Then you've got the middle 50 and then the most affordable 25%. The same thing is happening in Melbourne and Brisbane. So the biggest markets are being led by the most premium part of the market, so the blue chip areas. Now, I really do like some of this other data when we go into here, the sales and listings data. So CoreLogic estimates that there were about 40,000 sales in July nationally compared to the 5-year average of about 40,120. So we're at about parity now. The 6-month moving trend suggests sales volumes are stabilizing despite the low from the recent highs of 2021. So sales volumes are starting to come back. I'm going to point to this piece of data here, or reporting that came from Eliza Owen at CoreLogic, talking about the fixed rate cliff. So there was a lot of fear in the market about this fixed rate cliff, where essentially you can see from February 2020 to about December, even February-ish 2022, lots and lots of people went out and secured a fixed rate home loan at 2 to 3%. And there was this fear that all of these home loans, about 880,000, were expected to expire this year or throughout this year, which meant that you'd have a whole bunch of people going from a 2% home loan to about 5 to 6%, more than doubling their repayments. And the fear was that the market would collapse as a result of people not being able to afford the property. Now, what we've actually seen is we haven't seen any of these fears come to market. We haven't really seen any data to suggest that there have been a bunch of late payments or a huge increase in the portion of outstanding loans in arrears. And in fact, you can see here that the total arrears were higher in 2020 than they are right today, which is, you wouldn't expect that. So an arrear is, we'll just go here. Okay, so non-performing credit is a late payment of 90 days or more. This made up about 0.7% of all mortgages in the March quarter. Whilst other payments just starting to be late between 30 and 90 days was even less at 0.5%. So that fear of all these people not being able to afford their properties and then making late payments leading to selling their properties hasn't happened. There's a huge amount of the market that wasn't on a fixed rate. They were on the variable rates. They managed to absorb the the cost, and you can see that this absorption of that cost of paying for the mortgage has happened at the expense of not paying for other things elsewhere. So let's talk about that very quickly. You can see here, renovators put the brakes on the $11 billion market as cost crunch is happening. Basically, this is a news report saying that the GWA Group, one of the country's largest suppliers of bathrooms and kitchens, said it expects its renovation segment to remain subdued. The company says here the market would slide by about 8%. So people are spending less money on renovations and their bathrooms and all that kind of stuff. And then other companies that are reliant on renovations, such as the Good Guys and White Goods and JB Hi-Fi, said their sales have also dropped by about 8.1% in the 3 months leading to June 30. They said that here 12% in July alone compared to the same time last year. So what's happening is all these increases in the interest rates have led to people spending more money on their mortgage and then cutting out their discretionary spending and putting projects off. So that's pretty typical. People will pay for their own home, they'll pay for their rent and look after their house, and they'll cut out all the discretionary spending. And I'm sure we're going to see less discretionary spending out in the market. Retail is going to be hit, as well as going out and buying coffees and all that, cakes and all that good stuff. Cool. So let's go back to the data here. This is interesting piece of data here. We didn't see, the reason why the property market wasn't dropping for quite a while is we weren't seeing a massive amount of new property come onto the market. Listings remained very, very low and subdued and below a 5-year average. But what we've seen is an unseasonal amount increase in listings, where normally listings are quite low, as you can see between sort of March and September. During the colder months, there's less properties available to sell. And then they have the spring selling season from September to basically November. That's when huge amount of listings come onto the market. Now, this past month, we've seen a flurry of new activity come on, but the market's still grown in spite of the new increase. And CoreLogic basically says all these people have basically come on because of a confidence that's back in the market. We've seen it increase in price, and that's led to people then saying, hey, here's my opportunity to sell the property. We have had the largest sort of portion of people that are selling their properties are investors, but there are also those that are trading up as well. Now, this is another interesting piece of data here, median days on market. And the median days on market basically talks about how long it takes for a property to sell. The longer it takes for the property to sell is indicative of the market confidence and what's happening. So you can see here that over the past couple of months, the days on market has remained relatively stable, which is indicative, or in particular, has remained the most stable in the combined capital cities, but most turbulent in the combined regionals. So regional markets are performing very, very differently to the combined capital cities. A lot of the strength in the market is happening in the premium parts of the Australian property market. That's where the real strength is. Okay, this is what we're talking about earlier, how the listings have increased. Clearance rates, this is the percentage chance that a property is going to sell at auction, which is mostly led by Sydney and Melbourne because they're the clear auction markets. It's saying here it's averaging about 66.5%, which is about normal market. It has come back from the recent high of 71.3. So this is indicative that the market is kind of at parity. It's going to remain relatively flat and stable. Rents have increased quite significantly across the country, but are now, although growing, kind of slowing down their growth as well. And this is just a function of the amount of available stock. There's just not a lot of properties coming onto the market here. We've got dwelling approvals. ABS dwelling approvals dropped 7.7% in June. This comprised of a fall of 0.8% for detached housing and 16% fall in unit approvals. So as we've said, this paying attention to dwelling approvals is a leading indicator of how much stock or property comes into the market in 12 to 36 months. It takes about 12 months for a house to be built, sometimes a bit more. It takes between 2 and 3 years for an apartment project to come onto the market. And as you can see from this graph in the right-hand corner, decade average for units is well below the decade line, and same thing for houses. I mean, houses has corrected itself. This spike here happened as a result of all the government initiatives and bonuses for first home buyers and the new builder bonus during COVID. Okay, I won't bore you to death. I will do one last piece of reporting here. I want to refer to the Commonwealth Bank's data. Just to add a little bit more confidence, I guess, you're going to hear a lot of fear and doom and gloom, but the banks are performing very, very well. And you can see here, CBA is the biggest bank. And I was particularly interested here in the portfolio credit quality. And the credit quality is talking about, it shows a portion of new consumers where the customers have fallen behind on their contractual loan repayments. And you can see here that home loan arrears remained low, reflecting a low level of unemployment and the consumer saving buffers. Credit cards and personal loan arrears began to deteriorate, reflecting an increase in cost of living pressures. So basically, arrears is still very well low, and people have got a significant amount of savings in their offset, and we've still got a lot of strength in our home buyers. So the Australian property market is pretty strong. So what do I take out of all of this? Future supply is well below our 10-year averages. There's still a lot of stability and strength in finance and property market. We've seen an increase in some listings, and I feel like more confidence is going to come because we've seen an ease in the amount of rate rises recently. And if we do start to see a change in rate rises where we do hit a limit and eventually start to cut the credit and debt becomes cheaper, that's when we may see the next surge in property price increases. So happy investing, everybody. Happy house hunting. And as always, if you have any questions, reach out to myself or the team. I'll catch you later.